Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. Paul Winkler along with Evan Partner. So that's Arthur Brown. I've got it here. Maybe we'll play that. Might be fun.
It's a great clip.
Might be a little bit of it. We'll do a little bit of it. Yeah, let me check it out. Money and happiness. I see they're talking about money and happiness. If you can buy happiness, and Arthur Brooks, I always love him.
Yeah.
You know, I think that is his stuff is he's just a thinker. I loved his book, From Strength to Strength. Just about the aging. I don't know if I read that. Yeah, it's the idea of, the first part of your life. I talk about it a lot around here. I find myself with clients, who are getting older and they're going, they feel like they're kind of lost. And I go, no. Your life is changing. You're going from fluid intelligence, which is you're able to solve problems. You're able to create new things. People typically don't write hit songs. Sorry, songwriters, but a lot of people don't write hit songs. After their 20s, you might have it hit and miss. You'll have some stuff, but they typically write their best stuff in their 20s. You'll have people that create their best pieces of art before then. But there's something interesting that happens later on is that wisdom starts to kick in, and that's crystallized intelligence. And people, fluid intelligence wanes at about 45. So you got some of it until about age 45, and it starts to drop off a little bit. But it's not, that's not terrible. It's because what happens is then you get into crystallized intelligence, which is wisdom, and you have this ability to solve problems based on your experience, your wisdom, and your past things that you've done. Yeah. And you're able to do things that other people aren't doing. That's why your absolute best college professors are typically in their 60s or older.
Yeah.
Because they just have been through so much and they bring that stuff to bear.
They're approaching fossilized intelligence.
Fossilized. Crystallized, fossilized, whatever. You call it whatever you want. Arthur Brooks called it crystallized intelligence. Yeah. So
that was the last phase. Fossilized.
Oh, yeah, that's it. Yeah, that's it. But it's good read. It's really good reading because it takes some of the pressure off to do. It's funny because we'll have these things where I used to be able to solve a lot of complex math problems in my head, and I just don't anymore as like I used to. It takes me a little bit. And I might have to cheat and use a calculator here and there. But I know the concepts back and forward better than anybody else that's younger.
Yeah.
And can know what to access and where to go with a problem that I'm dealing with. And, I can use a calculator all day long. It's not a big deal. and I don't worry about it. But it was one of those really eye-opening books that I read regarding that. And it was about this guy that felt like nobody was going to remember him. And Arthur Brooks overheard him on an airplane and said, whoa, wait a minute. There's something going on here. And he started studying it pretty significantly. And he wrote a whole book on it.
Yeah.
Yeah. Okay. So do you really know what's going on in your 401k? Evan, do you really know what's going on in your 401k?
I do.
You do. Yeah, you really do. But most people don't. Leave it to the Wall Street to make a cheap, simple, elegant idea and junk it up with fees, complexity, and opacity. This, I think, Evan, is going to be an article I want to enshrine in here in some way and use it in future workshops because there is a line in here that I've got to get to and you got to hear. That's what's starting to happen with target date funds and the investment favored by tens of millions of people in their 401ks. A vehicle that couldn't be easier to own may soon become too hard to understand. Now, it says many of these funds are getting cluttered up with extra holdings or might get worse if so-called alternative managers have their way and start stuffing illiquid, risky, and often expensive private market assets into them. I said, the target date funds, so private assets, private equity, we've been talking about that a lot here on the show. Target date funds are permanent autopilot portfolios that neutralize self-destructive investing behavior. It's the idea that investors will screw up their portfolios when given the chance because they panic when markets go down. They get overly exuberant when markets go up. And somehow these target date funds, he's implying, were designed to solve that problem. More than 2/3 of all investment are participants in 401k plans. Most people, Vanguard said it was 80%, I think, over 80%.
Okay.
Are using at least one of these. But this is according to the Investment Company Institute. The other one was the Vanguard data I often quote where that's over 80%. Now, they said here's what they said in the article. When we invest, many of us need to be saved from ourselves. We might chase whatever's hot and dump whatever's not, put too much of our own company stock in there, and that's a problem because you work for the company and your company stock's in your 401k. Your company goes down, you lose your job, and you lose your retirement. Big problem. Or we diversify by haphazardly buying a little of this and a lot of that. Okay, now, I think I've had a conversation recently here about investment advisors. We've been talking about this a lot. And I said, you know what? I'm about at the point, and a buddy of ours, Mark, actually talks about this too. He's just like so frustrated with investment advisors.
Yes.
And he and I have had that conversation quite a bit. And I'm really on the same plane as he is. It's literally what happens is investment advisors, so it's like they'll never get it. And the problem is, I think, is they're informed enough where it's almost, they're too informed. And then what happens is when you know a little bit too much about investing, it's darn near impossible to get you to the point to think, hey, maybe there's something I don't know. And it's called expert bias. And the idea, it's a form of overconfidence bias. I just know this about investing. I see what's going on. I've seen this pattern before as an investment advisor. And here's what we ought to do.
Right.
We ought to change the portfolio around. Here's what we ought to be doing. And what they do and I said to the group in here, we were all talking about this, and I said, here's what happens. Clients are too scared quite often to make changes because they don't want to screw up because they know that they don't know.
Yeah.
You know what I mean?
Yes. Yeah.
And it's the investment advisors that think they know something that they don't know, because they've seen a pattern before.
Right. Right.
Even when we talk about that this market and say it's in a bubble, and I was kind of laughing at what those people had to say about a bubble. And I said, I'm not telling you I think it's in a bubble. I'm telling you I have no clue. And we will only know in hindsight whether the S&P 500 is in a bubble.
Yeah.
We don't know.
Well, to me, another aspect of this in terms of, I'll say the fear of not knowing about investing or thinking that you don't know much about investing. Going back to your earlier comment of crystallized versus fluid intelligence, oftentimes what you have is a 60 or 65-year-old client who has been through it, who has seen market ups and downs. They've seen recoveries. And you have an advisor that's 32, 25, and nothing wrong with being young.
True.
I mean, people got to start somewhere.
True.
But they're looking at the world differently, and they're still trying to be creative. Hey, how can I change this? What new thing can I do to kind of make a name for myself?
True.
And the 65-year-old investor is like, been there, done that.
I've been there, done that, got the T-shirt. And you know what?
Yeah.
I still have the T-shirt because I can't afford a new T-shirt because
Because I lost money in
That's right.
.com or Bitcoin or whatever. Yeah. Yeah.
Yeah. Now, these all-in-one funds are supposed to solve all this, he says. He says they hold stocks, bonds, and other assets in predetermined proportions, scaling down risk as investors age. Along the way, if stocks fall too far, too fast, these funds automatically buy. If stocks go up too far, too fast, these funds mechanically sell. And I was reading that going, that's what it's supposed to be, but I'm telling you is not what is happening in target date funds. It is never what has happened in target date funds. Thank you. And here's the evidence behind that. Asset mix. Listen to this, Evan. Asset mix average target date fund 2020 for somebody that should be retired already 5 years ago. So you're retiring in 2020, the year 2020. You would own a fund like this. and it is set up for you to be in retirement. How much in stocks? 40%. Average fund. How much in bonds? 60%. How much in large companies? 73%.
Of the stock.
Of the stock is in large companies, only 2% in small value. And what we know is that the greatest expected return is in small value, but we know that when we add that to the portfolio, what we have historically seen is we reduce risk when we do that, and they're not doing it. Do you know what the average alpha is on target date funds for that year?
For 2020?
For the target date 2020 funds, average alpha.
-2.
You're darn close. It's -3.
Okay.
So they're taking away. That means that the returns were 3% less per year for the risk being taken. Now, to put that in perspective, over a 30-year period, you have under 3% underperformance. That cuts your accumulation by about 60%. That's a big deal. Then they say, they got saying, set it and forget it was made for these portfolios. It's not much of an exaggeration to say that target date funds, the only decision you have to make is which one to buy in the first place. But no, they're not setting it and forgetting it. You may be setting it, forgetting it. They're not. Evidence. You ready for this? U.S. to International Fidelity Freedom Advisor Fund. I went back to a fund that's been around for a long time. After the run-up in the U.S. stock market in the late 90s, they had 16% of the equities were international. 16%, 84% were U.S. Now, after they have been so wrong for 25 years, and that international really was a diversifier, now they're up to 48% international.
48% international. Wow.
Isn't that something?
That is chasing performance. I can't believe it's that high.
Oh,
really.
yeah. I was surprised, too. And you know what? Take a quick break. There's a line in here that you got to hear. That I'm telling you, this is going to be something I'm going to use for years to come. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. Where I grew up, it was a whole lot colder than this around Christmas time,
sure.
Right? There was the land of June, July, and August, as we called it.
We would go to the beach for Thanksgiving and sometimes around Christmas.
What? Beach?
Yeah. I grew up in Houston, and so...
Oh, I guess you did. Okay,
sometimes you just go to the beach after Thanksgiving because it's still pretty hot.
Oh, man. Yeah, it's just, wow. It's Tennessee weather, right? You don't like the weather, just wait a couple days, and you just don't know what you're going to get. It's like a box of chocolates. Okay, so talking about, do you know what's in your retirement plan? Do you know what's in your 401k? I've got a whole video on this. We're going to be putting this out pretty soon. I got a little card that, and a little website that people can go to and watch this thing. It's not quite done yet. But it's getting there. But target date funds are, by and large, the biggest thing that people go to when it comes to 401ks. The idea is set it and forget it. You don't have to think about this. Don't worry your pretty little head. This huge mutual fund company that everybody knows the name of couldn't possibly be mismanaging your investment portfolio. That's just, and you don't know that it's happening because everybody's doing it. It's like everybody's driving 80 miles per hour down I-65, and, it's nobody's going to get pulled over because everybody's doing it. Well, if all the mutual fund companies are doing this stupid stuff with the management of portfolios, as we point out in this video, and I make the case, I go, hey, What are the rules of investing? What do you know to be true when it comes to investing? That I should buy low, sell high. I should buy and hang on to things. I shouldn't be timing the market. I should hold bonds, and therefore they are there for stability of the portfolio. Well, if you start to see that everything you know to be true is not happening, then you do wake up and go, maybe there's a problem.
Yeah.
But then and only then. And that's what I always spend the first meeting on when I meet somebody. But here's another thing going on. Ready for this, Evan? Another development in 401ks is more subtle. Now, number one, he said that they're introducing investments in there that shouldn't be in there or that are problematic and making them more complicated is the first point that he made here. He said another development's more subtle. Over the past decade, as the pressure to cut fees has intensified, we've got to get lower fees because the investor is primarily looking only at that when they're investing. And that is something that's been my complaint. It's like food companies saying we got to get fat out of the foods. Because if we get fat out of the foods, you will be skinnier. And then they go and put sugar in there and they make you fatter. No, it's not what happens. Not what's happening. But the food companies knew that you would buy the idea that if you get fat out of the foods, that you would buy the products. And people did in droves. They bought fat-free, low-fat products. Instead, they've been selecting collective investment trusts. CITs are pools of assets offered by banks and trust companies, often affiliated with mutual fund managers. So you got this big mutual fund company name behind it, right? So it's, hey, again, I recognize a company. And because I have that trust factor and that name recognition, I think it's better than it is. This is CITs are overseen by bank regulators, and they said not by the Securities and Exchange Commission. Unlike mutual funds, they aren't sold directly to the general public, makes them sound exclusive. So their lower marketing and regulatory costs typically make them cheaper, so they got a lower visible expense. So far, so good. Shift to CITs, which have grown 52% of all target date assets. 52%, nearly $2.1 trillion. And it has helped drive down the visible cost for retirement savers. However, CITs could end up being the gateway to higher costs. It's the gateway drug. Higher risks and lower visibility. CITs disclose some information about their fees and holdings, but nowhere near what a mutual fund company offers. For instance, it says Morningstar. For instance, prospectus of a target date mutual fund must report all fees of underlying funds. CIT, though, can invest in the funds and don't disclose every layer of fees in their own expense ratios, making it much harder for investors to figure out their true cost, such as venture capital, private equity, non-traded real estate, where annual fees can hit 2 to 8% or more. I'm telling you, this is what I've been talking about. They hide it better.
If the fee is hidden, is there any less impact to the portfolio, Paul?
No. Just like and throw a softball over the plate, baby.
Well, I can't see it, so it must not be there. Yeah.
Yeah.
Fees obviously matter, but when you were talking about the negative alpha in these target date funds, and just to make it easier, 3% of underperformance makes it easier conversation. Sure. So they're doing that for free, right? They're not paying there's fund fees, but I mean they're not paying someone like us to help create a portfolio and maintain it. So they're losing 3% of performance for free.
They charge very little to underperform, yes.
No, I'm talking about the investor.
I know, I'm kidding. Okay, the investor, okay.
And so the question I had received from somebody is, kind of like, how do you earn your fee? Mm-hmm. And I said, well, you can lose 3%, and I used a bigger number based on the Dow bar numbers, but just for this conversation, you can lose 3% for free. Mm-hmm. Or you could pay somebody whatever, 1%, 0.5%, whatever, to get the 3% that you were losing for free. Is that a fair trade? Absolutely. People look at numbers in the abstract and they don't really piece things together very well.
Well, I just think avoiding some of this stuff is an answer to that question too. Exactly. Yeah. It's not only behavior, but it's also stuff going on that you don't realize is going on.
Sure.
Mutual fund companies keeping revenue from securities lending, or, how they rebalance the portfolio. Yeah. What is the technique being used, to rebalance it? Are they just doing quarterly rebalancing, or are they doing it at all? You got a lot of stuff going on. All right. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.